Everybody that's joined so far. I think we will see people logging in as we go along, but not to keep everybody waiting. Just a bit of housekeeping initially. So this is an interactive webinar and we do have the chat box open. So for any questions that you might want answering during the Q&A session following the presentation, please don't hesitate, fire away. If there are any more complicated questions, we will be following up with you all individually following tonight. So you'll always get a chance, whether it's tonight or then, to get your answers, your questions answered directly. I want to say a massive thank you to our illustrious panel this evening, Will, who is in Singapore, Richard and Daniel in the UK, and especially to Laura, who is coming from Florida and is up at the crack of sparrows. In fact, it's not even light outside yet. So thanks very much, Laura, for your dedication. To start, I'm going to introduce global financial consultants. We can then hear from Laura and Daniel from Chastain and Partners, then Richard from Trireme Pension Services, and last but not least, Will from Quilter International. So, global financial consultants are the oldest non-institutionally owned advisory company in Singapore, and certainly one of very few in Asia. The company actually formed in Australia and moved over to Singapore in 2003. The founders, Bruce and Ian, still work for the company, and essentially we're run on family firm type lines. The team itself is incredibly diverse. We have advisors from all walks of life and experience, and the advice that we offer is completely impartial and holistic. For me, I think the reason why I wanted to bring this event to you is almost a fascination, for lack of a better word, when it comes to US expatriates and the problems that you face from an international advice perspective. And it really comes down to the first time I ever heard the word FATCA, or the term FATCA, which was overhearing a conversation between two of my former colleagues, essentially saying that they couldn't help a US national living in France. And I think it's a theme that's continued, really, whether it being international advisors not knowing enough about the US requirements, or it's US domestic advisors not knowing enough about things on the international side, even down to institutions not outrightly not accepting business from US clients. So hopefully tonight, firstly, Laura and Daniel are going to look at all of the potential pitfalls that you might experience as a US expat living overseas and at home. And then Will and Richard will follow on with that and hopefully highlight some potential solutions that might be able to help navigate that. Chastain and Partners, it's a boutique international practice with multiple offices in Central and West Florida, London, Grand Cayman, and Dubai. The firm itself is focused on serving global high net worth families, entrepreneurs, and multinational corporations and private equity firms. I will let Laura and Dan introduce themselves because there are a lot of abbreviations here which become incredibly wordy. So over to you, Laura and Dan.
Great stuff. And good evening, everyone. And David, thank you for that introduction. I'm just going to bring up the slides. Right. Can everyone see that? David, is that good? Okay, fantastic. Well, as I said, good evening, everyone, and thank you, David, again for that kind introduction and for allowing us the opportunity to speak about US taxes as they relate to US taxpayers living overseas. So I know David touched upon Chastain and Partners and what we do, but just for a brief overview. Essentially, we are a boutique tax group specializing in taxation for US individuals and businesses. Our particular focus is looking after US taxpayers with an international element to their tax affairs. So either a US person living and working overseas, or a domestic US taxpayer maybe has foreign-based assets and needs assistance with additional reporting and planning. For a relatively small firm, we have a pretty significant global footprint. Our client base is global. We have clients in Latin America, in Europe. We represent high net worth families in the Middle East, and we also represent clients in the Asia Pacific region. As David said, we are headquartered in Orlando, Florida, and we have offices in Tampa, London, and in the Middle East. Our team has a real global feel to it. We have over 100+ years of international tax experience combined. Of course, with the benefits of Zoom, I'm able to airbrush out some of those years of experience. But you know, there's a real global feel to our team. We're fluent in several languages. We have French, Spanish, and Arabic speakers. And presenting with me today is Laura Plotner. Laura is a CPA of nearly 30 years and heads up our Tampa office. Laura has extensive international tax experience and specializes in inbound and outbound issues for US taxpayers. In terms of my experience, I'm a dual handler. I'm both a UK chartered tax advisor and an IRS enrolled agent. So I'm licensed to practice tax in both the US and UK. I've been working in tax now for just over 20 years, 8 of which have been helping US clients in particular. And I've worked at a mixture of medium-sized and big 4 firms, helping US individuals with their foreign tax reporting. And now currently I head up the London office of Chastang Partners. That's who we are. In terms of what we're going to be discussing today, Laura and I sort of got together and pulled what we thought were the main issues for a US person living overseas. And these are certainly the more common types of issues that we see. So Laura's going to speak to you about the foreign earned income exclusion and how you can exempt foreign earned income from federal taxation, and then discussing foreign tax credits and how to help alleviate exposure to double taxation. I'm going to be looking at double tax treaties and then touching upon some of the informational reporting that could apply to a US person living and working overseas. Then Laura has the pleasure of speaking about an area that's a bit of a minefield from US tax, and that's sort of the dreaded PFIC, Passive Foreign Investment Company situation. And then I'll be finishing up with a review of foreign pension reporting for a US person. And then Laura and I thought it'd be good to go over a recent live case study that we had as an example. So I know we've only got 15 to 20 minutes to sort of highlight the main points on each of these topics. For example, the foreign pension reporting and PFICs, you know, these are hugely complex areas, and we could probably spend a couple of hours on each area. So it's difficult to try and condense everything into sort of 15 to 20 minutes. So by all means, if there's questions or you would like further discussion, then please feel free to drop us a line and we can continue this conversation offline. So now I'd like to hand over to Laura to speak to you in a bit more depth about the foreign earned income exclusion and foreign income tax credits. Laura, over to you.
Thank you, Dan, and hi everyone. Hope you're having a good evening. Thank you for joining. So as Dan mentioned, I was going to touch on the foreign earned income and housing exclusion as a starting point. So as US persons or green card holders or US persons living overseas, there are mechanisms that the US has in place that will avoid the double taxation situation. One of them is this foreign earned income and housing exclusion. So basically you can earn foreign earned income up to, as of right now, as of 2020, it's 107,600. That number does change every year for inflation slightly. The requirements are that you have your tax home in a foreign country. So you must be a bona fide resident of a foreign country for an entire tax year, or, and that's a big or, you can be physically present in a foreign country. So it might not be your bona fide residence, but if you're physically present in the foreign country for at least 330 days, you can also qualify for this exclusion. The important part of this 330-day test is that it's during, you can look at any 12-month consecutive period. So it doesn't necessarily have to fall under a calendar year. You can look to 330 days up until the time you actually file your tax return. So it could flow into the next year. So if you're a calendar year filer, which as an individual, you wouldn't file your tax return until October, potentially December of the following year. So you can actually look at that period as well. So there's some ways to meet that test. Foreign earned income would be things like wages, salaries, bonuses. What it doesn't include is in any type of passive type income, dividends, interest, or capital gains. The housing exclusion is also allowed. This allows certain housing expenses, rent, utilities, repairs, to be deducted from taxable income. The expense limit for Singapore, it does depend on where you're located. The expense limit is 82,900 for 2020. Now it's important to know this is the expense limit. The deduction is actually limited to the exclusion amount. So, but that is the maximum amount of expenses that you can incorporate into the calculation. In order to take the earned income or housing exclusion, you do need to file a Form 2555 with your 1040. And you always want to make sure that your advisor is optimizing your position. You are allowed to take either the foreign earned income exclusion, or you can take foreign tax credits, which kind of lead us into our next slide. You can take foreign tax credits as another mechanism to avoid double taxation. So if you choose to take the foreign earned income exclusion, according to the prior slide, you can't take a foreign tax credit on that same income. However, you can take both the foreign earned income exclusion and the foreign tax credit in the same tax year. So that's why it's really important to maximize that. You can actually do both. You can take one or the other. So it's really critical to kind of keep an eye on that. The most important thing when taking a foreign tax credit, and a foreign tax credit is basically a dollar for dollar tax credit against any tax that you pay in the foreign country, against the US tax liability. You can never take more than or get a credit for more than the US tax liability. However, you can potentially carry credits forward. So, it's always a decision which way to go. The most important thing with the foreign tax credit is to make sure it qualifies as an income tax. The only taxes that are allowed as a foreign tax credit are actual income tax related taxes. So like a VAT or some other type of property tax, would not be allowed for this foreign tax credit. You can also claim the credit based on cash paid. So it could be on a cash basis, or it could be on an accrual basis. If it's on a cash basis, just be aware of the timing of the payments, because that could, there's a lot of, sometimes it doesn't coincide necessarily with the income. So that's something that we're always, again, very careful about. And, you want to check with your advisor and how that's being handled. If you choose the accrual method, then once you choose it, you basically are in that method, and that becomes the method that you use going forward. The other important thing to know about foreign tax credits is that you actually use different baskets. So we call them baskets. There's a general limitation basket. There's a passive income basket. So if you're earning wage income, active type income, then those credits would fall under a general limitation basket. if you're earning investment type income, those would land into a passive income basket. These are important because which basket, you can't cross credit potentially. And so you have to be cautious about how those credits are applied. And foreign tax credits, the calculations themselves are very, very complicated. And as Dan said, we probably could spend, a crazy amount of time talking about tax planning and how to maximize credits. But I would just, advise that, again, if you have foreign taxes paid, make sure that that the credits are being maximized each year. The foreign tax credits are reported on Form 1116 on your 1040, and that's how you would essentially claim the tax credit. And I think Dan's going to kind of lead us into double tax treaties.
Great stuff. Thank you, Laura. Appreciate that. Yeah, as Laura said, I'm going to be just giving an overview now of double tax treaties and their purpose. I know, and we'll discuss in a bit more detail, that the US and Singapore doesn't have a double tax treaty, but I think it's good to give an overview to you guys, especially as it's going to be important, I think, to what Richard's going to be discussing later on. So the way I like to think of tax treaties are as tax tools. So you have your default tax rules as defined under the US tax code. However, if you have income or assets in another jurisdiction and you are a resident in another country, then you can dip into your tax toolbox and hopefully use a tax treaty as a tool to mitigate any double taxation, or perhaps get clarity or guidance on how certain types of income are taxed in those jurisdictions. So the purpose of a double tax treaty is just that. It helps alleviate double taxation where the same income is subject to tax in two jurisdictions. It also helps provide guidance in terms of which country has taxing rights, how certain types of income are taxed, and also provides helpful guidance, for example, in terms of someone's residency. So an individual may meet certain domestic residency tests in two countries, and then the treaty provides a tiebreaker, allowing someone to claim a specific place of residence, assuming the tests are met. So the US has a relatively extensive treaty network. It has tax treaties with just over 60 countries. But when you compare that with someone like the UK, they have a tax treaty network with over 130 countries. So there's still quite a few countries that the US doesn't have a treaty with. And as I mentioned, Singapore is one of those. So this means that the chances of double taxation increases. You don't have access to that tax toolbox. You can't benefit from those certain provisions that allow certain types of income to only be taxed in one country. You have to adhere to the regular tax code, perhaps in both jurisdictions, meaning double taxation is a high possibility. That said, the problem with being a US citizen, resident or person is that the US retains its right to levy taxation on a worldwide income and gains. So care must still be taken when using a double tax treaty. All treaties have what's called a savings clause, and this essentially preserves the right of each country to tax its own residents and citizens as though the treaty was not in effect. However, the savings clause generally accepts certain types of income from its application, meaning that if you are a US citizen or resident, you can still benefit from some aspects of the treaty. But it's important that as a US person, you can't automatically assume that if you are able to use a tax treaty with a country you're resident in, that you can benefit from all that the treaty offers. You do need to be aware and review that savings clause to ensure what types of income are covered. One use of tax treaties that we find particularly helpful with US persons is the area of foreign or non-US pensions. So pension income is typically excluded from the savings clause, allowing the treaty benefits to apply to a US person. For example, the US and UK has a really comprehensive provision in its tax treaty, which essentially allows a US person with a UK pension to benefit from tax-free deferral until distribution is made upon retirement. There are also provisions that allow lump sum payments to be made tax-free in both jurisdictions. So a tax treaty can be hugely advantageous. I would just caveat that with the fact that the international tax landscape has certainly changed dramatically in the last few years, and countries are more widely sharing information about taxpayers in a bid to sort of clamp down on tax avoidance and tax evasion. So just be mindful that there are provisions in place to prevent the abuse of using such treaties, and especially be mindful that if the end result is zero taxation on the same income in two countries, then there's likely to be provisions in place. So you need to just be aware of that. And finally, my last point on using double tax treaties as a US person is there is a reporting requirement. If you're taking a treaty position, you do need to report this separately on Form 8833, which is a treaty-based return, and this forms part of your regular tax return, your Form 1040. So unless otherwise exempted, if you're taking a position on a return and you're relying on a benefit provided in a tax treaty, it's extremely important that this form is completed and filed with your 1040. Otherwise, the IRS can seek to deny that relief and possibly tax income or deny exceptions. So it's extremely important to get that form filed. So quickly moving on to another area of information reporting, and this is, I guess, the two forms, the FBAR and the 8938. These are the forms that we most commonly see with regards to a US taxpayer living overseas, and also actually one of the most common forms we see missed as well. So the FBAR form, as it's known, or technically known as the FinCEN Form 114, this has been around for quite a few years. This was formed as part of the Bank Secrecy Act back in 1970, whereas the 8938 form is much more recent. This applied for most individual taxpayers from 2011 onwards. And we mentioned tax tools earlier. These forms are exactly that for the IRS and US Treasury. These are the tools they use to make sure that a US taxpayer is reporting fully and paying applicable US taxes on their foreign income and assets. There is some duplication with these forms. So if you reported foreign financial accounts on an FBAR and you meet the 8938 threshold, then you would have to report those same accounts on the 8938 form. So, it can be a bit of a pain. But just as a quick recap, for those of you who aren't aware, where you have a financial interest or signature authority over any non-US financial accounts, and the aggregate value of those accounts exceeds $10,000 at any time during the calendar year, then you need to report those accounts on an FBAR. There's no tax due with the form, it's purely an informational filing. And this is filed electronically. The due date is April 15th each year, but it is extended automatically to October 15th. And that is a separate filing to your 1040. So on the flip side, we have the 8938, which is the Statement of Specified Foreign Financial Assets. And this forms part of your regular US tax return. The reporting thresholds for this form are much higher than the $10,000 limit for the FBAR. So as a unmarried US taxpayer living overseas, if your asset value is greater than $200,000 at the end of the tax year, or greater than $300,000 at any point during the tax year, then you need to report those assets on Form 8938. If you're a married filing jointly taxpayer, those thresholds are doubled. And just be aware, if you're a US taxpayer living in the US, those thresholds decrease dramatically. Examples of reportable assets include foreign financial accounts, interest in foreign stocks. If you have an interest in a foreign corporation, partnership, trust, those are the type of assets that need to be reported. And whilst these forms are just an additional layer of reporting with your tax return, it is so important that these are completed correctly and filed timely, because both forms carry significant penalties. The FBAR, for example, has varying degrees of penalties based on the taxpayer's facts and situation, but the penalties do start at $10,000 per form per year. So definitely worth making sure that these are done correctly. And my last point on this is just to highlight that the IRS does have procedures in place to encourage and facilitate getting back into compliance and filing delinquent returns without penalty prosecution. A lot of our work is in this area, and we help a lot of US taxpayers with their historic delinquent filings. And I'm going to talk about that in a little bit more depth at the end of the presentation. But now I'm going to jump back to Laura to let her speak about some other layers of information reporting for foreign assets.
Thank you, Dan. Given our time, I want to be respectful. I think we we'll probably just fly through this next slide. But I wanted to just mention that, excuse me, that the items on this slide, those questions are important. If you do own more than 10% of a foreign corporation, or if you are the beneficiary of a foreign trust, you know, any of these things will apply. It will be important to make sure that your US tax advisor is aware of this, because as Dan mentioned, the penalties are severe, and it's become really critical just to make sure that you have everything in compliance. And one other thing I would just mention on this slide is that, you know, sometimes we have people holding a green card, maybe taking a treaty position, as Dan mentioned about the treaties, for income tax purposes, but they don't realize that that the actual filing requirements for the forms are still there. So it doesn't actually exclude you, even though you may be taking a non-resident treaty position. It doesn't exclude you from the actual compliance. So just something we wanted to mention. I think I'm just going to flip through the PFIC as well pretty quickly. A PFIC is a passive foreign investment company. So if the foreign corporation has at least 75% of gross income from passive sources, or 50% of its assets are held for the production of passive income, then you potentially have a PFIC. The tax treatment can be really punitive, and so it's very important. Your capital gains can get taxed at ordinary rates, and there can be all kinds of tax traps with a PFIC if your tax advisor is not aware of it, that you've invested in one. We actually work with a lot of the financial advisors of our clients to make sure that they understand the taxation. The client and the advisor is aware of also the compliance that goes along with the potential PFIC. So, you know, again, this is just more of a heads up that, you know, if you do invest in some type of a foreign passive, it could be a mutual fund, an ETF, various insurance products, pension plans. It could be even rental properties, depending on some factors. So just be aware of if you are investing in these passive type companies, just to be aware of that and make sure that your US advisor is kept in the loop.
Great stuff. Thank you, Laura. I know we're pushed for time, so I'll just run through this last slide, and then perhaps at the end, if we have time, I can talk to you guys about a recent case study that Laura and I had. But just switching gears slightly now and looking at foreign pension or retirement plans. I guess with the introduction of the 8938 back in 2011 and the possible penalties for failing to report foreign assets, you know, it's certainly focused the taxpayers' mind and their advisors' minds when it comes to foreign pension reporting. And, you know, as I mentioned, you know, this is a hugely complex area, and we, I guess, typically like to review these on a case-by-case basis. But ultimately, the treatment is dependent upon the taxpayer's fact pattern, the country they're residing in, the type of pension or retirement plan that they are contributing into, and do they have access to a tax treaty, all of those factors have an impact and ultimately determine the US tax treatment. So going back to basics, if we were to consider a US qualified plan, so a 401k, for example, contributions are not counted as income. Savings grow tax deferred until retirement and a distribution is made. Unfortunately, most foreign plans are not qualified for US tax purposes. So what does that mean for a US person with a foreign pension plan? Well, the first question is, are you resident in a country or participating in a pension plan in a country that has a tax treaty with the US? If the answer is yes, then there's light at the end of the tunnel. You know, as we said, the tax treaty often allows exclusive taxation of pensions under the domestic law of the resident country. So it generally puts the US taxpayer in a much more favorable position. But as I mentioned earlier, the US does not have a tax treaty with Singapore. So as a result, pension income can be double taxed, I guessed. So without the protection of the treaty, contributions to a pension plan in Singapore could mean that employer contributions are treated as taxable income. Growth in the plan is treated as taxpayer income in the current year. And taking it a step further, if the pension plan is created in a way that's structured as a trust, then that could trigger a whole level of additional trust reporting for the US taxpayer. And it really can get quite complex. And then to throw into the mix, if the foreign pension plan doesn't have treaty protection and has invested in foreign mutual funds or other similar type products, then again, it could inadvertently open the taxpayer to a whole host of PFIC issues, as Laura said. So by simply providing for retirement by using foreign pension plan, you could inadvertently end up with quite a nasty tax result. But there are planning opportunities available when it comes to these types of foreign plans. And this is something that Richard is going to speak to in more detail. But just one final point on foreign pensions, and that is not to overlook the FBAR and 8938 reporting. It is likely that those plans need to be reported on both forms. So what I'd like to do now is hand back to David, and if there's time at the end of the session, we can talk about the case study I had, but I think we're overrunning as it is.
Yep, thank you very much, Dan and Laura. Obviously, just from what you've said then, it is a bit of a minefield in terms of everything that you need to remember. So when it comes to strategy and planning for pensions, etc., this is what Richard and Will are going to be looking at now, because essentially, if you need to be looking at this individually yourself, then there is a lot for you to remember personally. So what we want to look at are potential solutions whereby it's all kind of done in-house, essentially. So over to Richard. So Richard is coming from Trireme Pension Services. They are an independent cross-border specialist pension service provider that blends technical expertise and operational know-how to provide professional services to a variety of personal and occupational pension solutions. So Richard's actually based in the Guernsey office. They do also have a Malta branch as well. So yeah, over to you, Richard.
Thanks very much. Good evening, everyone. Hope you're having a nice evening. Still daylight here, which is good. And not quite as early as in Florida, obviously. No, great to meet you all. Yeah, some really good points have come out of the presentation I've just seen. Fantastic. Trireme Pension Services is a business that, as was said, runs mostly out of, well, we have pensions in Guernsey, the UK and Malta in the main. For these purposes, we'll be speaking about US pension plans. It's called the US International Retirement Pension Plan, and we run that out of our Malta office. Now, the key question that everybody's got following the presentation I've just seen is, does Malta have a tax treaty with the US? Yes. Does Singapore have a tax treaty with Malta? Yes. So those are the important questions, I think, to answer there. That allows for the US International Retirement Plan to distribute gross to a US national regarding of the US national's residence. So we would distribute gross to you in Singapore the same as we would to you in the US. The Malta-US treaty protects that position. It also allows for the plan to invest into what would otherwise be considered PFICs. It's not a PFICs in our hands as a US compliant pension, so it can invest far more freely. Yes, it will create FBAR and 8938 planning, but we're well aware of that, and we provide you annually with the information you need to produce that filing as well. So kind of dealing with those points that have come out of the presentation before, hopefully, in terms of what the plan actually is and how we can use that. So it allows you to make contributions to that from sort of tax paid earnings. So tax paid dollars that can go into the plan. The plan can then grow. It's got gross roll up, so it goes free of annual US tax charges. It can invest very widely. And at the end of the day, we can take a pension from that. The Malta-US treaty, and again, I think Dan alluded to this. It does protect a capital payment to be taken from the pension. It also follows the Malta pension rules in terms of the access to the pension. So a Malta pension can be accessed from age 50, and so can this pension. So it is possible to take an initial lump sum of 30% of the value of the fund from the pension from age 30, and then go into a more traditional drawdown from the pension, and/or it is possible in certain circumstances to take additional capital payments following the Malta rules. And again, the capital payments are protected as capital in the US Malta Treaty. So it can be used to build a pension. It can be used to invest more widely. Also, it doesn't matter where you are in the world to make those contributions, and it doesn't require a US employer. So aside from a 401k, many Americans that we work with actually originally go offshore and have access to a 401k, especially if they've gone with an American employer. Then they may leave that, and the ability to fund a 401k is then not open to them. We're aware, obviously, that often an individual retirement account or a Roth IRA account would generally be funded. And if you're looking for a comparison, actually the US National Law Journal helps us a bit with the comparison to this. They sort of compared us very much to a Roth IRA, and actually they use the word the supercharged Roth IRA, because actually there's no limit on the contributions that can be made to the plan, because there's no tax relief going into the plan. There's no tax on the growth of the funds within the plan. There's the ability to take capital payments of at least 30% from the plan, and then the remainder of the plan that you take will be taxed, but obviously not until a point that you draw that down. In terms of how it's structured, so again, importantly, in terms of reporting, we tried to put this together to create minimal reporting relief. We're aware, working a lot with the American expat community, that you're aware that you've got the tax liability. That's part of being an American citizen wherever you are in the world. But actually creating additional reporting is an unnecessary burden. So we structured this as it's a contract-based pension from what's called a Maltese EU CCAV. So it's an EU CCAV fund. Specifically, the reason for this actually was not to create a trust. It isn't a trust. And the reason it's not a trust is that definitely minimises the reporting. If it was a trust, it would be a foreign grantor trust, and that would create additional reporting. So it's not, and it works well on this. Obviously, it's based on opinions from our US attorneys that we work with, not Chastang and Partners. They're an organisation that obviously we're working together on this presentation, but that it's not their opinion that's been used here. But obviously, we can help you with those, and there's various attorneys we work with as well as Chastang. So that's kind of the bones of how the plan works, how it can be developed, how it can grow, and how it compares. As I say, it's often used. It's quite a useful savings plan, and a lot of American expats would use it in this way, because actually the access from age 50 is far more attractive than 59 and a half potentially. It's often a time of life when people are looking to access some capital. Maybe the kids are going to university, maybe the kids are looking for a deposit on the first home. Those kind of things are really useful at that age. Yeah, we'll support you guys in the growth. We can answer all the questions. And Daniel has information surrounding this. We've produced some fact sheets on this. There's some scheme particulars, obviously, and some information around this that can be accessed, obviously, through Dan probably. But if you have any direct questions, please don't hesitate to come to us directly and ask us, you know, as you see fit. So hopefully that sort of gives a bit of an idea of how the plan works, how it can be built up, and actually importantly, it's if you leave Singapore and go back to the US, the plan is still fine. If you leave Singapore and go to Europe or go to the UK, which obviously from 1st of January is not Europe anymore, but if you go to those different jurisdictions, you can still access the plan, you can still contribute to the plan. And because of the US-Malta Treaty, which is it's actually a model US treaty, so the way that treaty works, it distributes gross following that treaty to an American regardless of their residence, as long as they're still a US national. So that's kind of how that treaty works. So that's quite important, because actually, you know, I've worked with American clients before, and they've worked a bit in Singapore, they've maybe gone and worked in Hong Kong, they've then come and worked in Berlin or in London, or, you know, around the world, and actually you end up building pockets of pensions all over the place, none of which are really make much sense, some of which are built up in jurisdictions without US tax treaties, which just further complicates things, as you know, the guys have said, whereas this allows you to actually build an effective saving plan with good ability to invest outside of your normal investment parameters. So all the things that were mentioned as PFICs, you can invest into in the plan without those PFIC reporting and tax considerations. So hopefully that's a useful summary into what the plan is. And I think that puts us right back on time, so I'll pass back to the guys.
Perfect. Thank you very much, Richard. Yeah, I mean, it's especially referring to it as a savings plan, not just a pension. I think that's pretty spot on. And again, with expatriates that tend to not stay in one place and building up different pockets of money, that's usually something that we see from an advisor's perspective with clients that we meet. So the ability to potentially have something that is portable wherever you go, essentially, it does seem to be the best course of action. Next up, we have Will Price, who is the head of international distribution at Quilter International. So it's your third decade, is it, Will, in the industry?
It is, yes. Yeah, I started back, when was it? 99. So yeah, just in my third decade now, and 13 years in Singapore.
So Will is, so he's in his third decade in the insurance, structuring and high net worth investment space. 2014 or 2013, did you say, with Quilter, Will?
2014, I started with Quilter, yeah.
2014. And previously with Zurich, which is one of the leading expat insurance firms. So essentially, Will knows everything you need to know about structuring assets, tax minimization, and legacy planning across numerous nationalities. So I think that pretty much speaks for itself, Will. But Will's going to follow on from where Richard was discussing potential solutions and how Quilter would be able to kind of help you facilitate that as well. So over to you, Will.
Cool, thank you, David. Let me just share my screen. Hopefully you can see that okay. Yeah, okay. So yeah, as David mentioned, I work for Quilter International, which is one of the largest cross-border wealth management firms around. This particular topic obviously is the US retirement solutions. But first of all, I'll give you a bit of background on Quilter International, as you may not have heard of us in this part of the world. We are headquartered in the UK FTSE 250 organisation, as you can see, managing 110 billion sterling of investments for somewhere in the region of, I think, 60,000 clients. We have a good strong rating from Fitch. So, you know, we're a large, well-established organisation. So a good place for clients to place their money and invest with us. The international part of the business was formerly known as Old Mutual International. We rebranded back in February of this year, and we specialize in cross-border multi-jurisdictional planning for clients. Many of our clients are expatriates. We have offices in Hong Kong, Singapore, Dubai, Europe, UK, and Latin America. And we specialize in those clients that are either from other countries, may move to other countries, or that simply have assets in various different jurisdictions. And that brings a lot of complexity with it that we can help to manage and to minimize some of those issues, and in particular, manage the tax outcomes that clients are looking to achieve. The organization, as I said, it's headquartered in the UK. We have many different arms to our business. We work on the financial planning side of things in the UK. We have a discretionary fund management service also in the UK. And the international bit of the business, which is the section that I represent, we're headquartered in the Isle of Man. We have an office here in Singapore, fully regulated by the MAS, and all the safeguards that provides. So what do we offer? We offer a product that has various different names. When you're from the UK, as I am, we refer to them as offshore bonds, which sometimes confuses people. They're also called insurance bonds or private placement life insurance, which is probably a more commonly used terminology in the US and Europe. Essentially, they are insurance policies which act as an investment wrapper. So they are an efficient, low admin way of investing funds and accessing markets for your high net worth to mass affluent clients. The type of investments that you can invest into are the type of investments that Daniel was quite rightly pointing out that you probably wouldn't want to invest into unless it was via a sort of pension scheme such as that provided by Trireme. So this solution allows you to invest into things like unit trusts, ETFs, shares, and so on, without the usual issues that come with that if you were to do so directly as a US citizen. We have somewhere in the region, I think it's about 36,000 assets available for use on our platform at the moment, and we add to that constantly. So you have a very wide range of assets that you can access. That's something that many US citizens struggle, as David mentioned at the start of the talk. Many clients struggle to find a home for their investment because lots of institutions won't accept US citizens because of the extra reporting requirements and so on. That's obviously something we're very happy to do and enable clients to access markets. The fact that we are consolidating assets on one platform as well is a useful tool, both for a pension provider such as Trireme, as it reduces the amount of reporting, and also for the client as well. We obviously have lots of literature on this, which David will be happy to provide for you. And then I'm just going to run through a sort of brief case study as to how these plans work. Richard has touched on some of this already, but this will give you a working example, as it were, as to how this could benefit clients. So in this case study, we have a chap called Brad who works in IT in Hong Kong, could equally be Singapore, obviously, and he has currently wealth in the region of 3 million, and that he's looking to invest. Chooses to do so via a US international pension plan, and the underlying investment product, obviously one of our products from Quilter International, has a selected retirement age of 50 and makes an initial contribution. With the of 500,000, if you grew that 500,000 by 5% per annum, 15 years later, by the time that Brad is 50, that would now be valued at $1 million US. So you've doubled your investment, and that investment is comprised of 50% was the original capital, 50% of that is the growth. So when Brad reaches 50, he can decide to take up to 30% out as a lump sum, as Richard mentioned. So that would be 300,000 in total. equally split across the capital and growth pots. And then after, when they decide to take that money out, there's no US federal tax or Maltese tax to pay. So that's 300,000 that they can access when they reach age 50. No immediate tax liability. And then after that, the remaining 700,000 in this example, the pension provider Trireme would calculate the life expectancy for the client. If we assumed that was going to be age 85 for Brad, then you work out using an actuarial computation exactly how much you would be able to provide on an annual basis. And in this case, that provides an annual income for Brad of $40,000 going forwards for the remainder of his expected life. So that's a very quick overview of the product and the investment platform that we provide, how it could be useful and how it works in conjunction with pension providers such as Trireme in allowing clients to access the type of investment instruments that they might want to avoid, as per what Daniel and Laura were pointing out earlier, and give them the kind of investment opportunities and growth that otherwise they might struggle to access. So yeah, that's just a very quick overview of what we do, and then I'll hand back to David and any questions that people may have.
Richard, anything to add to that from Trireme's perspective?
Just, I suppose it was just one thing on when the income was generated at 40,000 a year, because half of that is effectively base and half of that is growth. Only actually 20,000 that would be taxed as well, so it's quite attractive. So you've got the capital lump sum out, you've got 40,000 a year. Because the lump sum has been worked out across the two pots, effectively you've got 500,000 of base, 500,000 of growth. That base is never taxed again. So actually that 40,000 annually would only actually be taxed, 20,000 as income and 20,000 would be return of capital. So that's quite important to remember as well. And it's important to say as well, there is absolutely no tax at the Malta end. The distribution will be made gross under the terms of the treaty. And also actually if you do remain in Singapore to take that pension, Malta also has a tax treaty with Singapore, so the position would be complete gross distribution. So I guess that's the only thing to add at that point, but yeah.
Great. Then you mentioned that there was I think you have run through briefly with me previously, but the case study that you have with the Hong Kong client that you and Laura had. Can you please run through that for us?
Absolutely. Let me just bring that up. Yeah, thank you, David. So this was a recent case that Laura and I advised on. We were introduced to a US person that had been living and working in Hong Kong for the last 5 years. He had filed his 1040s and correctly filed the 2555 to report his foreign earned income exclusion. But when he got back to the US, he subsequently read an article about the foreign bank account reporting for US citizens. So worried that he hadn't filed FBARs and concerned that he had missed some other reporting, he got in touch with a local international tax attorney who then reached out to us and to handle his amended tax returns and FBARs. So I mentioned earlier that the IRS have procedures in place to allow taxpayers to come forward and get compliant with their international tax reporting without penalties being levied. And this was one such case. This is a procedure that's known as the IRS Streamlined Foreign Offshore Program. And essentially this allows someone to file tax returns or amended tax returns to report undisclosed foreign income and to also file FBARs or amended FBARs without the hefty late filing penalties that we mentioned of minimum of $10,000 per form per year. So penalties can really start building up if you've missed, say, 2 or 3 years of reporting. So one of the conditions of this program is that taxpayers need to sign under penalties of perjury that their non-compliance was due to non-willful actions. So they can't have purposely chosen to not report on their foreign assets and then suddenly decide to come clean. you know, there needs to be a supportive argument for their non-compliance in the first place. Then, rather than going all the way back to year one, i.e. the start of their non-compliance, under this program, they only have to file the last 3 years delinquent tax returns or 3 years amended tax returns and the last 6 years FBARs. They would have to pay any additional federal income taxes due and interest, but they wouldn't be subject to criminal prosecution and they wouldn't be subject to the late filing penalties that we discussed. So in this particular case, the more we dived into this guy's fact pattern, we found that in addition to the missed FBARs and the 8938s, that he'd also been contributing into the Hong Kong Mandatory Provident Fund, which is the compulsory retirement scheme for Hong Kong residents. And unfortunately, in the absence of a tax treaty with Hong Kong and the US, the taxpayer had to amend his tax returns and report additional income, and the additional income being his employer contributions to this fund, as well as the current year growth. Now, fortunately, he was only there sort of 5 years, so the income in question wasn't significant, but he did have additional taxes to pay. But the real saving grace on this was, you know, he didn't have to worry about the late filing penalties that could have been levied should the IRS have come to him in respect of the 8938 reporting and the FBAR reporting. So that's just a common scenario that we see, clients coming to us after the fact and then us and or attorneys helping to correct their prior year filings. You know, it's so much easier if as a US taxpayer, you're aware of these pitfalls, you're aware of these challenges, and you're aware of the opportunities so that you can take appropriate measures now to get that planning in place. And, you know, as they say, proper tax planning keeps Uncle Sam at bay. So that's all I wanted to say on that.
Great, thanks very much, Dan. I think with that, given the similarities between the Hong Kong financial system and the Singaporean system, I think that it does leave a lot of opportunity for people to be caught out and potentially quite terrifying. So yeah, it's as long as everything is planned correctly, I think that those situations can be avoided. I think we're about done unless everybody has anything else to add, but we are going to just wait and see if anybody has any questions. Let me just open the chat box and the Q&A box. Okay, so no questions yet. I'm assuming that means that everything has been explained pretty succinctly. So we will be following up with you all individually anyway. So if you do have anything that's a little bit more private or anything a little bit more complicated, as I say, we'll follow up with you and you'll get the chance to get your questions answered directly. We are also going to forward you all a link to our YouTube channel, which will have a recording of the webinar. So yeah, thank you very much, everyone, for attending. Thank you especially to our panelists and Laura for it's now light outside, which is good. So yeah, thank you very much all for joining. Oh, sorry, wait, I think we do have a question in there. Sorry, yes, all of the contacts from the presenters will be sent out as well. Lee, thank you very much. So yeah, you'll get your chance to answer question directly the presenters. No problem at all. And another one. Sorry, they're coming in now. Okay, thank you, Lee. No worries. Okay, great. Unless there's anything else, thank you very much for joining, and we'll speak with you soon.
Thank you.
Sure. Thank you, guys.